The scandal was not about whether the United States could repay a 2-year note. It was about who controlled the available notes between auction, settlement, and delivery. In May 1991, Salomon Brothers and its customers won 87% of a new issue at auction. The joint report by the Treasury, the Federal Reserve, and the Securities and Exchange Commission cited Salomon's statements, putting their combined position after further purchases at almost 94% by settlement. That distinction matters. Credit risk can be low while trading and funding risks are high. The puzzle is how an instrument treated as safe became scarce enough to distort both its cash price and the market used to finance it. The sale of Treasury bills, notes, and bonds finances the United States government. Treasury securities are also a savings vehicle for a wide range of households and an important source of collateral and finance. That gives the auction process two jobs. It must place government debt at competitive prices, and it must give market participants confidence that no bidder has a hidden advantage. A distorted auction does not merely hurt one trader. It can change the price of a benchmark security, disrupt firms that promise to deliver it, and weaken trust in the market that supports government borrowing and monetary operations. Before settlement, the coming security could already trade in the when-issued market. A dealer could sell the future note to a customer, then obtain the note at auction and deliver it on the issue date. This helped Treasury discover demand and helped dealers distribute an issue, but it also created short positions. A dealer that had promised more notes than it later received still had to buy or borrow the exact security. The auction and the secondary market were therefore mechanically linked. Concentration at the auction could become scarcity at settlement. Treasury rules capped a single bidder's recognized bid and award at 35% of the public offering. A bidder also had to report a sufficiently large net long position because notes already controlled before the auction counted toward that limit. The rule was designed to keep one participant from gathering enough supply to dominate everyone who still needed the security. But the limit depended on accurate names, customer authority, and position reports. If a dealer placed its own demand under customer names or omitted an existing position, the auction system could mistake one economic buyer for several independent buyers. Salomon admitted submitting unauthorized customer bids in 5 Treasury auctions from December 1990 through May 1991 and uncovered evidence of 3 additional unauthorized bid violations. The clearest early breach came at the February 21, 1991 auction of 5-year notes. Salomon admitted placing 1 bid for itself and 2 unauthorized customer bids, each for $3.15 billion at the 35% limit. Together, they sought 105% of the offering and won about 57% after proration. The customer labels made the orders look separate even though the economic result flowed back to Salomon. Senior Salomon executives learned that the head of the government trading desk had submitted a false Treasury bid. The SEC later found that John Gutfreund, Thomas Strauss, and John Merriweather failed to investigate adequately, discipline the trader, or report the matter for several months, during which additional violations occurred. This delay is the central governance link in the chain. The first false bid was no longer only a trader problem once senior leaders learned about it. Their failure to act allowed the misconduct to continue. At the May 22nd auction of 2-year notes, Salomon failed to report an existing $590 million net long position. It also submitted a $2 billion customer bid even though the customer said it had authorized only $1.5 billion. Then Salomon obtained the extra $500 million. Salomon and its customers received 87% of the amount offered. After further purchases, the joint report said their combined position was almost 94% by settlement. The report carefully noted that much of the customer bidding was authorized and within individual limits. The problem was the extraordinary concentration combined with Salomon's admitted position and bidding violations. A short seller that had promised delivery now needed the exact May note from a market where very little remained outside Salomon and its customers. The joint report said unusual distortions in the cash and repurchase markets followed the concentrated awards, and that information available to Treasury officials suggested the squeeze resulted from that concentration. It did not claim that every holder acted as one conspirator, so neither should we. What it documented was scarcity. Salomon and its customers lent some notes through repurchase agreements at special rates generally 100 to 200 basis points below prevailing general rates. Holders of the scarce collateral could therefore obtain unusually cheap cash financing, while the other side accepted a lower return to gain access to the note. Complaints and price movements made the shortage visible. On May 29, 1991, Treasury staff notified the SEC about the apparent squeeze, and the SEC opened an inquiry the next day. Document requests and a parallel Justice Department investigation led Salomon to hire outside counsel and examine its own records. On August 9th, the firm told Treasury and the SEC that it had found irregularities. Further disclosures followed on August 14th. The market distortion did not by itself prove the false bids, but it created the trail that brought investigators to them. Federal Reserve Governor Jerome Powell later recalled that the scandal threatened to bring down one of the largest financial firms of the time. Over one August weekend, Treasury first prohibited Salomon from dealing in government securities for customers, then reduced the sanction after top management left and Warren Buffett became interim chairman. In May 1992, Salomon settled federal civil charges without admitting or denying the SEC allegations. The settlement required $290 million, with $190 million going to the United States Treasury and $100 million funding civil claims. Access, leadership, and money all moved because hidden bidding had become a threat to confidence in a critical market. The response targeted the weak links the scandal exposed. Treasury broadened the firms allowed to submit customer bids. The Federal Reserve Bank of New York began spot checks of customer bids, and customers receiving awards over $500 million had to verify them in writing. Treasury adopted a policy allowing extra supply when an acute and prolonged squeeze developed. The auction system continued to evolve, and Treasury says all marketable securities have used single-price auctions since November 1998. Today, competitive awards remain limited to 35% of an offering after accounting for the bidder's reportable net long position. Not every later reform came from one scandal, but the 1991 episode made identity, concentration, and verification impossible to treat as clerical details. The lesson is to separate the promise of an asset from the machinery that trades it. A Treasury security can carry very low expected credit risk, while a specific issue becomes hard to borrow, expensive to obtain, or disruptive to settle. Auctions, position limits, customer verification, repo funding, and the ability to add supply are parts of the safety system, not background paperwork. The same framework applies beyond treasuries. When many contracts require delivery of one scarce asset, concentration can turn an ordinary obligation into a market bottleneck. That is an educational way to read market structure, not a prediction about prices and not a recommendation to buy or sell anything.